All right, good afternoon, everyone. Hope you're all doing well. We're back here again for lesson 9 regarding when to trade versus when not to trade. So, for every point made within this video on when you should trade and any point made in other videos in the past or in the future, every point made as to why you should trade, if that point is not present, then we do not trade. So, this lesson covers when to trade versus when not to trade, mainly when I personally, fearing, determines when I should trade, step away, and not look at the market at all. Because, of course, you guys are watching my video in particular for this topic because you want to understand how I view the market, and this is how I go about it. So, in all my videos, I've taught you when I look for an entry, how to trade, when to take trade setups, but what I've not done is explain how to determine a high probability condition versus low probability condition, because this is a main factor to determining my success rate since I trade a discretionary model. In my previous lessons, I cover CISDs, SMT, and my entry models, but that happens all over the time. It happens all over the place. But it is what I teach in this video that determines which ones are more than likely going to play out versus unlikely to play out. It's all based on probability, and this is a main factor that determines a profitable trader versus unprofitable trader. So, in this video, I have 4 points that determine when not to take a trade. After this, I will be covering, the basics such as bank holidays and so on. But of course, those who are watching my videos, I know you guys are a little bit more advanced than the rest of the community. So I want to get right to the point regarding the most important topics. So first one, when our external draw on liquidity has been hit. So every single day, we go into the market with a predefined plan. Analyze the higher time frame market sentiment, aka the basics of the market structure. Are we making higher highs, higher lows? Are we making lower highs, lower lows? Are we bullish? Are we bearish? The simplest thing you can do. I just analyze whether or not the higher time frame is bullish or bearish. Then you want to study the development of our weekly and daily power 3, which I already have a video on for my top-down analysis video explaining that. And based off both of those, from there we get our higher time frame external draw on liquidity. So in this example here, we can see that, and this is a recent example from last week, and we'll start off by studying the development of our weekly power 3 so far. So as we can see overall, and excuse that, higher time frame is overall bullish. When we zoom in a bit, look at the development of our weekly power 3, and the day that we run out the previous month high is Thursday. So zooming back to Monday, more like Sunday, 6 p.m. open, back here, we can see that overall price is just accumulating. Following the accumulation, we see a midweek manipulation down into a daily BISI right here, Wednesday, into a daily BISI, running out. All of this lowers this liquidity, giving us our midweek reversal. There was a cracking correlation with YMF lows as well. Nonetheless, just focus on pattern for now within our weekly power 3, a very clear classic bullish weekly power 3 model. Midweek reversal into Wednesday, Thursday continuation. So where is our draw on liquidity? Because after we see our midweek reversal, the first clearest time-based draw on liquidity is the previous day high, which is this high right here, the Tuesday high, which we run out during Wednesday. Now, what would be the clearest draw on liquidity externally after that? Because if we look here, there's no other internal structure high, there's no other clear high that we can really target. So we zoom out, we utilize time. We're already above the previous week high, which was back here, or my bad, which was back here. So we're already above the previous day high, we're already above the previous week high. The only other clear draw on liquidity would either be a higher time frame inbounds or another time-based high, which in this example was our previous month high. So our previous month high was also a monthly for value gap. So giving us a very clear draw on liquidity, higher time frame inbounds, previous month high. So that was our draw on liquidity going into this day. That was our higher time frame external draw on liquidity. Go on to the 5-minute time frame. So as we can see here, I was on the 15-minute time frame when making my notes. But anyways, as we can see here at 10:30, price runs out the previous month high. Before we even get into that, within the development of our daily power 3, we can see that leading up to New York open, we run out the London low, from there, we reverse, going right back up to the previous month high. So the topic that I'm going to cover next is when price runs out both sides of delivery, and that's exactly what we did here. We ran out both sell side and buy side, running out the previous month high. So at this point, when we run out the previous month high, with trying to play continuation of the trend to a random, you don't really have a clear John liquidity higher, just trying to play continuation of the trend is just extremely high risk. And what's even higher risk is trying to trade the reversal, because at this point, every single time frame is bullish. The 1 minute time frame was bullish back here, the 5 minute, the 15 minute, the 1 hour, the 4 hour, the daily, the weekly, all those time frames are bullish at that point. So trying to perfectly predict the reversal is just setting yourself up for failure. Sure, we do end up getting a reversal lower, but the chances that you would have caught that are very unlikely. And I actually fell victim to this. If you guys stay up to date with my social media, you will see the trade recording that I posted for this day, Thursday, May 1st, 2025. And I fell victim to that. I was break even twice before it ended up playing out. And the reason being, it was simply low probability conditions. Now, low probability conditions don't mean you can't catch a trade or that price won't move. It will, but you do not want to be trading when the probabilities are against you. If you study any professional, any trader who's been in the game for a long time, you'll always hear them say that they only are looking for the highest probability trades. And if a setup occurs that doesn't match their highest probability criteria, then they simply do not take it. They have no interest in risking funds when it does not match or does not meet their highest probability criteria. Because as we can see here, after we run up the previous month high, we get a little bit of a rebound down into this unbounced range below. And at that point that we get that rebounds from 1150, more like 1155, up until 350, so about 3 hours worth, or my bad, about 4 hours worth of price action essentially just accumulated after running out the previous month high. So chances are you would have been chopped out, and it wasn't until the end of the day macro that we ended up spiraling lower, which was stalling specifically for earnings. We had Apple and Amazon, or perhaps this was Microsoft. No, this day specifically was Apple and Amazon. So price was stalling for that. But nonetheless, point proven that probabilities are just against you after we run out a higher time frame external Joe. Now, on to point 2. We want to avoid trading prior to high impact news. So that would be such as avoiding 11 a.m. to 1:59 p.m. if we have FOMC at 2 p.m. And the best conditions that we can wait for if there is high impact news is to wait for after that is released. So in the example below that I'm going to reference on this chart right here, in this example, we can see that we have 8:30 news and 1:30 p.m. news. As I marked out here and here, obviously I don't have the 8:30 news marked out, but I have the 9:30 open marked out. Anyways, in this example below, we can see that Powell is speaking at 1:30 p.m. EST. Well, even though we have 8:30 high impact news, overall price delivery within the first 30 minutes, as we can see here, from 9:30 up until 10 o'clock, were pretty poor. Without running out this low, as we can see, we just engineered liquidity at the lows. When we see something like this happen, we just want to avoid all of the market until that significant news event is released, 1:30 p.m. news. When we see price do stuff like this, when we see price engineer liquidity prior to a high impact news event, you want to wait. It is the market purposefully doing that. It is engineering liquidity in anticipation for that news event to run it out. It is no coincidence here that we perfectly engineer liquidity at the lows and perfectly wait until exactly at 1:30 when Powell starts speaking to run it out. That is not a coincidence. That is perfectly coordinated, and that's exactly what you want to avoid. You want to avoid trying to trade before that. So 8:30 news, sure, you can get a nice setup at market open, but if that nice setup does something like this, like let's say you were bearish, you got shorts back here, if we engineer liquidity at the lows, unlucky for you, but accept the loss, accept the break even, accept potentially took a TP1 and then break even. accept it as it is, come back later after Powell is done speaking. It's just generally you want to avoid 30 to 60 minutes before any high impact news event. But when it comes to often Powell or FOMC at 1:30, 2 p.m. or 2:30, you generally want to avoid the entire lunch session, the entire AIM session. Keep an eye on the first 30 minutes, but anytime after that, you want to avoid the market until Powell is done speaking or until FOMC wraps up. That's just how the market is. If you don't listen to my advice, you'll learn through your own experiences, you'll learn through your own losses, and you'll figure it out on your own. When it comes to high impact news such as 10 a.m. news, I would say avoid the first 30 minutes, avoid 9:30 to 10 o'clock, wait for that 10 a.m. news to pass by. I'm not saying you can't get a setup before 10 a.m. news, but it is just high risk. And again, we're looking to trade the highest probability setups, not the lower probability setups. And when it comes to 8:30 news, 8:15, we usually aren't ever trading before then, but if you're trying to trade pre-market, my advice is simply waiting until after that passes, especially if you're a London or Asian session trader, which I doubt if you're watching my videos, but you want to avoid the overnight session if we have significant high impact news at 8:30, just generally in the morning. If it's PM session, sure, perhaps Asian session would be pretty nice, and that actually was, as you can see here, actually that's London session, but with quite the expansion up to that daily doubles mark. During London, and oftentimes it's pretty clean like that if we do have high impact news in the PM session, but that's just for you guys to figure out. Now on to point 3, and this point is being do not trade after both sides of delivery have been delivered. So something to keep in mind is that the market only does so many things. Of those things, there's the 4 main topics: to hunt liquidity, to rebalance equilibrium, to rebalance the inefficiencies, to generate liquidity. Those are the 4 things that market is doing. Now, these can be split up between buy side delivery and sell side delivery. And when buy side and sell side are taken in a particular trading session, we can assume that price will slow down the rest of the day and engine liquidity for the following day. So as you can see here, we can see that prior to our new daily open, we run out the pre-sale low, as you can see here, in the form of sell side. Something to keep in mind here that you can't see, but you can go back to this date. You'll see that the higher time frame order flow is bullish, generally very, very bullish with clear on liquidity higher. Overall, we're looking for longs. But as we can see, leading up to market open at 8:30, price starts expanding. 8:30 starts rapidly distributing, leading up to 9:30 open, where 9:30 continues that distribution, which ultimately at 10 o'clock, we end up running out the high week. Now, something to keep in mind, there was not really a clear higher time frame on liquidity that was nearby. So once both sell side and buy side have been taken, there's no other clues on liquidity that is reasonably going to be taken. You want to avoid, especially after such strong expansion like this. Now, that is proven based off the delivery that you can see after 10 a.m. So after 10 a.m., you can see how weak these candles start becoming. They slow down. They start becoming about 3 times smaller, 4 times smaller than these large displacement candles back here. You can very clearly see the shift in the overall delivery of price. Now, something you're probably asking is, why would we not look for shorts back down into this unbalanced range below? Simple answer. Because it does not need to be balanced within the same trading session after both buy side and sell side have been delivered. We got to keep in mind, when price is rebalancing to EQ, that's not something entirely different in itself. This entire move higher, that is all buy side delivery. When price is going higher, that is delivering buy side. When price goes lower, that is delivering sell side. So here, what we did here, we already delivered buy side. This is all buy side being delivered. And we already delivered buy side, we already delivered sell side. So there's no real reason to deliver sell side once more within the same trading session after it has already been delivered back to back. But what we can do is wait for the new daily open, waiting for a new day to start. And I want you guys to start thinking about this as the system / the market resetting, Essentially, the market is given new task for the new given trading day, is given new draws on liquidity. So think of the market as a system, the market resetting at a new daily open, and it's given new task for the new given day. It's given new draws on liquidity. But as you can see here, after a new daily open, price rebalances the previous day's range, not the previous day's range, but from the previous day's high day back down to the initial expansion is what I've drawn out here. Now on to the fourth reference as to when not to trade, and that is outside of 9:30 opening on no high impact news days. So on no high impact news days, often on Mondays or Tuesdays that don't have high impact news, on these days we generally want to avoid later in the day. Why is that? Well, simple, because the only clear injection of volatility that we have on no news days is at 9:30. Anytime after that is pretty much just gambling with assuming when price will and will not expand. And there's not really any need to show an example for this, as go back, look at the market. You're essentially just gambling 50-50 whether or not the market will expand, will it be injected with volatility after our 9:30 open. My advice, and before anything else, I'm not saying that price can't be volatile after 9:30 open. I'm just saying that you do not know when that will happen. You'll often just be sitting on charts for hours waiting for something that is just more than it's very, very unlikely to even end up coming. So my advice is just avoid these days after 9:30 open, because 9:30 open is the only clear injection of volatility. Anytime after that, just step away. Now, this is a little reference when to trade versus not to trade. So you start off with, is your model present? Is it clear higher time narrative? Is it clear on liquidity? No. Okay. Turn off chart. Yes. Okay. Wait for a clear opportunity. Enter, exit, and turn off your chart. That's all it is. And yeah. So now we're going to get into a personal live trading reference of the trades I've been taking over the month of April in my live trading calls. And actually before that, let's just talk about what I've written down here. So out of 20 trading days within a month, the markets really only give you 5 to 6 really good trading days, like absolutely beautiful delivery, only about 5 to 6 times out of the month. And of course, we want to be there. We want to be there executing on those days. We actually want to be taking trades on those days. And this requires you to have a lot of patience and the discipline to just sit on your hands doing nothing. It comes down to showing up to the market and realizing that there's nothing there according to your model, and being content with that, being just going and saying, okay, I sat here for the last few hours, I did not make any money, but I'm cool, I'm calm, I'm fine with that. Reason being is because you know that according to your system, your model, that you know that it makes you money over time. So regardless if you take a trade or not, as long as you're following your plan, you're following your rules, you're following your model, you are still getting 1% better every single day. But every single time that you break your rules, you don't follow your model, you do something other than the plan that you set out for going into the day, you're slowly becoming 1% worse. It doesn't matter whether you made money or lost money following that or not following your model. It doesn't matter if you made money or lost money, you are getting 1% worse every single day. You're breaking your habits, you're breaking your plan, and that's slowly declining your improvement. So instead of taking trades that aren't your model or trading at low probability conditions and blowing through thousands of dollars, setting yourself back by blowing accounts or losing a ton, you follow your plan. You will have an account that you'll be able to trade on the next day without having to think about the loss they took the previous day by not following your model and knowing you want to make it back. Or you end up taking a low probability trade and you lose. So when eventually that high probability trade presents itself, you're going to hesitate. You're going to be too scared to enter because you destroyed your mental capacity by not following your model on the previous day and taking a loss. You're going to hesitate when the time comes where your high probability model actually presents itself. So you have to follow your plan. You have to follow your rules, or else you won't be able to execute when that time comes to press a button. when the high probability time comes. Now into the reference regarding my personal live trading. So on average, I'm taking about 1 to 2 trades a week on the live. Now you might see on my socials I'm taking a few more trades than that, and those trades that I do take outside of live trading are strictly high risk / not following my models. And whereas the live trading trades that I do take are strictly following my classic 30-minute power 3 model, 4 power 3 model, and executing on them live, following a strict plan. And with that said, there are many times where I miss entries, have a wrong bias, so I'm not always open to catching longs, even if the setup is clear, because I might be bearish biased. And so there is times where I could be definitely taking more trades a week on the live, but again, there is human error, or I can have the wrong bias, or just miss an entry, happens too fast, and I miss it, and then boom, it plays out without me. There's plenty of times where, I'm just going to miss an entry, and that's just how it is. Nonetheless, we are not taking multiple trades a day, let alone every single day. You will really only get a high probability setup 1 to 3 times a week, and that's just the reality of it. That is just the reality of it. So like, as we can see here, beginning of the month, April the 2nd, we can see that again, classic 30-minute power 3 model, took longs 150 points. Following day, I believe this was might have been the 4 power 3 model, but anyways, shorts. Following day, or following week, took a loss. And that was the only trade that week. That's just how it was. Had the bias right, had the drawn liquidity right, simply just got stopped before it ended up playing out. Next week, come back, take a win. It's 133 points, only was able to lock in 70 points, but that's just how things are. The week after that, took the biggest live trading trade to date, was for 240 points, as we can see here. And then the week after that, another trade following my 30-minute power 3 model. While this trade ended up being a win, ended up profiting off of it, ultimately I did have the wrong bias and drawn liquidity, which is why it did not play out entirely. But that's just how things are. The highest probability models only going to present themselves so many times per week. But our only focus is just being there, being present in the market, not taking dumb trades before or after, and just focusing on actually be present in those days and executing on them. Because even though it might not seem like a lot of trades, it isn't. But I think the total sum of that was about 640 points that was caught over the month. And when that's copy traded over multiple accounts through TopStep, through Apex, and other firms, it adds up. And even if it's just on one single account, 640 points caught in a single month, you're doing better than 99% of total traders. Because of course 90, 95%, 99%, that's still non-traders who fail. And of those who even do make it, are they guaranteed to make that many points? Probably not. So that's something to keep in mind for anything else. And when not to trade. My bad, I kind of repeat myself here. I'm going to actually delete that when I go back and edit this Notion. But we're going to reference, to be honest, I'm going to delete that this entire portion right here. So thank you for those who are watching so far. Anyways, back to the basic stuff for when not to trade. It would be, we're not trading bank holidays. That's obvious. There's no volatility in the market, so we're not going to trade then. We're not going to trade hours prior to FOMC or Powell speeches, as we talked about before. And we're obviously not going to be trading during news events. So if Trump's speaking, if Trump's speaking, we're not going to trade. We're not going to be trading on the singular NFP release. We're not going to be trying to enter a position, trying to gamble whether or not CPI, PPI, or NFP is going to go higher or lower. We're not doing that. We're following a plan. But majority of how I find my highest versus lowest probability days are often based off my news event. While I am active in the market almost every single day, I am following the rules that I set up above, but the days that I prioritize are based off the economic calendar, which I'm not going to cover all this, but you can find that on Forex Factory. And our focus is catching the weekly distribution. So something to keep in mind is that, so like the basics of everything is in a market maker model and constantly in a power 3. And when you're thinking about open low high close, open high low close, which is what power 3 is, we know that Mondays and Fridays tend to be our low probability days. Not because they're untradeable, but because the bulk of the weekly expansion tends to happen between Tuesday and Thursday. So Tuesday, Wednesday, Thursday tends to be when the bulk of the weekly candle distributes, expands. Monday tends to be our entering liquidity, and Friday tends to be our, slower day, rebouncing in the range. You can say that, the the markets are getting ready for the weekends, whatever you want to say. But that's essentially how things are. You're going to, every single week, like more often than not, you're going to just look through weeks past, you're going to see that Tuesday, Wednesday, Thursday tends to be our days that expand the most. So we can identify days from the economic calendar read for the news, and we know that the algorithm specifically waits for days like these to take place. They induce volatility into the market, often because we're going to have a large move, and it won't be on Monday. So like a week like this, or more like a week like this that I'm showing here, would be Monday, Tuesday. Very obviously, we're not going to see very large expansion. We might, but we're not guaranteed. We're only going to be focused on 9:30 open. Whereas Wednesday and Thursday, being CPI and PPI, it's pretty logical to assume that the bulk of our weekly expansion, like if you were to take a complete guess as to which days are going to expand the most, you would more than likely guess Wednesday and Thursday, being CPI and PPI, middle of the week, more than likely going to expand the most. And we want to be a part of those days, because the highest probability days, the largest expansions, are going to be on days like this. Not guaranteed always, but again, it's about probabilities. What's more probable to happen? And of course, like I said, lower probability days are going to be the days with no news at all, especially if we have high impact news later in the week. So like this Monday and Tuesday, which is 2 months from now, or no, a month from now, we're really going to avoid Monday and Tuesday. We're going to be very cautious. We'll pay attention to 9:30 open. Anytime after that, we're done. We are done. We will have our chances Wednesday, Thursday, Friday, but Monday, Tuesday, no news. We're better off just not trading those. We can already guess a month ahead of time that these days are going to be low probability. Okay, come back a month from now, see if I was right or wrong, and learn for the future. But that's generally everything I wanted to talk about. I'm going to go back and edit this Notion a bit, but overall, I talked about everything I want to talk about. The 4 main reasons as to when not to take a trade. Learn from this. If you don't learn from this, if you don't apply what I talked about here, it's very simple. You'll learn from the mistakes yourself. That's all it is. If you don't apply the concepts I talked about today, if you don't have the discipline to step away like I talked about today, you will learn on your own, and maybe that would be better. Perhaps if you just listen, but if you just listen to me today, sure, that's great. But I guess if you never really experience what it's like to not follow your rules, we'll see. Who knows? But if you have guys any questions, please let me know. The Notion document, the updated one, will be in the description below, as well as my other socials and so on. If you guys have any questions regarding the live trading, the trades I take, let me know. But until the next video, you guys have a great rest of your month.